Welcome to Dr. Fred Markets. This is not financial advice. While most people scroll past the noise, a few take the time to understand what's really going on. Finance, crypto, artificial intelligence, this is where it all connects. You made the right choice being here. Let's dive in.
AI isn't an industry, it's an energy derivatives trade in drag. Verdict: if your AI exposure stops at Nvidia and a couple of shiny cloud names, you're betting on the slot machine and ignoring the casino. Signal 1. Look where the power actually goes. Every dollar of AI capex is essentially a prepaid energy bill. The IEA now pegs data centers and AI at low single digits of global electricity use. But here's the knife twist. Hyperscalers are locking in tens of gigawatts of future power through long-term contracts. That's not demand growth, that's an AI tithe. Microsoft, Google, Amazon, they aren't just buying GPUs, they're stapling 10 to 20-year power purchase agreements to them like a mortgage on silicon. Signal 2. Grid chaos is turning into a monopoly gift. In big AI build-out states, regulated utilities are quietly filing rate cases that explicitly mention data center and AI load as justification for massive capex and higher allowed returns. Translation: AI is coming. We're about to spend billions on wires and turbines, and regulators, you're going to let us earn more on it. This is the only business where our cost base just exploded becomes, and now our profit ceiling goes up too. AI turns boring grid companies into leverage on guaranteed demand. Signal 3. The green AI story is just a cover for energy cartels. While tech CEOs sermonize about net zero, they're stampeding into nuclear, hydro, and high-capacity gas plants like it's a land rush. Private deals, off-market contracts, bespoke tariffs. AI isn't decarbonizing the grid, it's ring-fencing the best energy assets for whoever trains the most models. Everyone else gets the leftovers and the higher bills. Here's the cliff. If AI is the new railroads, the market just handed you the locomotives and ignored the steel, coal, and land under the tracks. Here's the connection nobody wants to say out loud. AI is just a hyper-financialized energy arbitrage. Mechanically, every AI model is a spread trade between three things: cost of electricity per computation, capital cost of hardware that turns electrons into predictions, price you can charge for that prediction. The hardware, GPUs, already got repriced to the moon. The prediction side is still a knife fight. Nobody knows how much margin survives once AI chatbots are as common as pop-up ads. That leaves the quiet middleman, the energy system that never negotiates, never posts on Twitter, and always gets paid. When Microsoft pays to lock in nuclear or wind for 15 to 20 years, they're admitting one brutal fact. The bottleneck in AI isn't smart people or better models, it's whose electrons get priority at a predictable price. That's not a tech problem. That's an energy balance sheet problem.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Energy companies, especially those with regulated returns or long-term contracted generation, now function as passive AI toll roads. They don't care which model wins. They don't care if it's OpenAI, Anthropic, or some kid in a garage. As long as GPUs inhale power, they clip their coupon on every token generated. The mechanism: AI volatility, energy stability. AI profits will be boom-bust. New model, hype spike, then margin compression. But once a utility rate base expands for AI load, it almost never shrinks. Regulators hate stranded assets more than they hate price hikes. So the grid gets a ratcheting floor of demand, while AI gets a roller coaster of valuation. This is where you stop thinking like a fanboy and start thinking like a landlord. AI companies rent energy. Energy companies own the stuff you can't copy-paste: land rights, transmission corridors, nuclear licenses, long-term gas contracts, existing interconnects. That is the choke point. You don't need to guess who ships GPT-7. You just need to know that every version after it runs hotter and hungrier. Here's what this means for you. One thing you didn't know: that shiny AI ETF you're proud of is secretly one side of a spread trade you're not hedging: long GPUs, flat energy. The smarter capital isn't bullish AI, it's long both ends of the trade and letting retail hold the bag in the middle. One mechanism you now understand: AI's true margin is the gap between the cost of electricity and the price of inference. Whoever controls their power, costs controls their model economics. everyone else rents. One action you can take: map your AI hype to its energy spine. If you own AI-heavy names, study which utilities and energy producers are signing long-term deals with them. Watch where new data centers are actually being built, which grids, which fuels, what contract terms. Treat those energy names as your AI hedge. When the narrative whipsaws, electrons still get paid. This is not financial advice, but here is the truth. The future of AI returns doesn't belong to whoever writes the smartest code. It belongs to whoever owns the cheapest, most reliable watt feeding the machines. 3-point summary. 1. Every AI dollar is an energy prepayment. GPUs are just the interface. 2. Utilities and energy producers with long-term AI-linked contracts become silent partners in every model's P&L. 3. If your AI portfolio ignores the power stack, you're the product, not the investor. If you learned something, fix your portfolio story. Stop saying, "I'm long AI," if you're not long the power behind it. Subscribe, and tomorrow we'll follow the electrons again, not the marketing. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.